All right, guys, we're doing another one. So today's subscriber request is Procter & Gamble. So with Procter & Gamble, I think we'll, again, begin with the price action to kind of discuss a little bit, and we'll talk about the company. But I think most of you are very familiar with Procter & Gamble. At least if you're not, I will try to ease that right now. And basically what this is one of the largest, if not the largest, I think it is the largest consumer packaged goods company in the entire world, boasting about $366.34 billion market cap. Now, over the course of its entire life, it has done very well. Okay. Very well. Okay. And again, this is not including dividends reinvested, because had someone reinvested the dividends, the returns are well above this, right? This is just simply the price action on the capital return side of things, right? And a lot of people really love this company for dividend investing, right? And right now, the gap PE is about 27.08. So what's quite interesting is, had you been buying this in 2017 around there, the multiple is actually a lot lower. So this actually experienced a good degree of multiple expansion. So there's a couple ways in the stock market how we can actually generate returns on capital, or returns on our capital as an investor, right? We buy something, the business improves, and then they maintain a multiple. But there's also such thing as multiple expansion. So had you had bought Procter & Gamble back in the day, I think it was trading at sub 20, easily sub 20. I think it was like at 15 or something like that, below 15. So not only did the business grow, but also the dollar amount per share that the market was willing to pay also rose alongside that. So it's quite interesting when you really get down to it, multiple expansion, and what are the implications of that in terms of an overall return. But you can have the double whammy of a growing business and multiple expansion, and you would actually generate really good returns. Okay, so from here, let's actually go over to the annual report, and from the annual report, we can look at the income statement. So again, we have seen that the business has grown. Now, this is a company that is a little bit more inflation resistant than your average business, right? They have a plethora of brands from which they sell to consumers, and when you go to a store, whether it's Target, Walmart, or wherever you are in the world, you might actually see, and they have a lot of international brands too. This is a very large company, but they have a plethora of brands. And sometimes you think that these two brands are competing against each other, but they're actually owned by the same entity. And in this case, it could be Procter & Gamble. Now, Procter & Gamble over long periods of time has been a master at developing brands. We all know about their Gillette debacle, which I'll just mention right here real quick. So the whole Gillette debacle was they put out an advertisement that kind of almost like shamed men, and then they reversed course, and then they came out with an ad that was like completely in the opposite direction, because again, they were trying to like stir up attention, right? And they were getting squeezed on the ends by Dollar Shave Club, which I think is owned by Unilever, and all these other companies that have spurred out since then. And I think they kind of only exacerbated the death of that company, or not the death, but they severely harmed the brand in a lot of ways. And they did actually showcase that, because back in that day, they wrote down the value of Gillette on their balance sheet. So they reduced the goodwill. It was a goodwill impairment charge. I don't know if we might actually see that here. Yeah, we're probably not going to see that in this explanation, but looking at the assets, right, we see that they should have goodwill somewhere. Where are you, goodwill? There it is. There's goodwill. So they still have about $40 billion in goodwill, all that to be written down in the future. No, I'm kidding. But the point of this is, we are looking at something that, again, in terms of long-term debt has, it's nothing they can't handle relative to the cash and cash equivalents. And, they have drawn down the cash pile. They might have been doing increasing buybacks or increasing that dividend. Again, this is more of like a cash cow business. A lot of the businesses that they operate under are kind of stable, already mature business lines, except they are experiencing a good amount of growth, and they can grow with inflation, because their brands per se have a lot of pricing power relative to other types of businesses where you may not have as strong a brand, right? Branding is very important in the consumer package space, and Procter & Gamble definitely does have perhaps some of the best brands, if not the best brands in the entire world. Now, looking at the operating activities, we do see, again, this is a positive cash flow business. This is an old, boring business. Not really many people like this. A lot of people will kind of think about this company and think, of an older generation investing in this business and just, again, compounding the dividends over years and years and years. Okay. So again, that's pretty much like the sentiment you get, or the feel for it. All right, let's go over to the model and actually plug this guy in. And you guys can see the remnants of the last video I made. But Procter & Gamble, we'll just plug that in. Of course, these growth rates are not going to be applicable. So let's go ahead and erase them before the model actually starts up. So it's still not loading in. So let's actually, oh, okay. Now when I say that, it loaded in. It's like I'm shaming it. And then it's like, okay, I'll do it. So price action or price target, sorry, by analysts is about $146.32, right? So they're just actually under it. So we're implying a negative 4.48% downside. Let's actually change this to a 10% to start off. And, since we're already looking at a profitable business, we have to actually say no to that. No anomaly. And we are not going to do the unprofitable analysis. So no unprofitable analysis on there. Yeah, and none of this we don't really care about because we're already not doing that analysis. So let's take a look at the growth rates that we can assume. So they've grown on average at about 3% over the past years. So 3% there. And then let's say they grow at 10% on the high end, not 140, 10%. All right, so if they can grow at 10%, we're pretty much there. But we can kind of see or get a feel for how expensive this business really is. This is not priced unlike before where it was priced better. This is, again, trading on the higher end of where it usually trades at. So on a PE of 25.67 and a price to free cash flow of 23.57. So yeah, I'm already starting to see Procter & Gamble. Basically, the market is willing to pay more for it for the perceived stability of this. Similar to like a Coca-Cola, right? If we actually were to throw in Coca-Cola, and you know what, I might as well just throw in Coca-Cola for you guys. We probably will see a similar sentiment. And again, Coca-Cola has experienced, again, that multiple expansion. So even with Coca-Cola making these assumptions, it is considered by the model to be overvalued. And I don't think we're going to get 10% unless we see drastic inflation and persistent inflation. And in that sense, in the nominal basis, they will be growing, but not on a real basis, like on a real value per se basis. So these businesses are approaching cash cow era levels. But again, this is a business that if I could get it at a very good price, definitely it'd be something I'd be interested in. It just has to get to that good price. Now, if we look at return on invested capital for this business, it is a very good business by just looking at that metric, 30.66%, return on assets of 11.99%. Sorry, did I say that was return on equity? Return on invested capital is 22.14%. Taking a look at the ratios over here, we can see that the current ratio is below 1, but again, not really a concern for this type of business. Long-term debt ratio is manageable. They kind of keep it range bound, not too crazy, but it has risen as of late. Long-term debt ratio, kind of like a similar story. Long-term debt to capital, similar story. So we're kind of getting a story from the numbers there. Gross profit margins have risen though. They are getting more for the same, but it's kind of recovering from 2011 there, which is actually quite interesting, but nothing crazy. They have pretty much, I consider that to be remaining steady. Operating margins has risen though. So they are becoming a more efficient business. It is fluctuating. We have high years of 2017, low years of 2019, but it is remaining range bound. Okay. And then ROA, ROE, pretty good. ROIC, really good. Earnings quality. This is a fantastic business. I would expect nothing less than a high earnings quality rating. All right. So I guess we'll kind of finish off there, but the summary is this business is a good business. It's a fantastic business actually, except it's just not at the price point at which I would be willing to buy it. The price would have to come down drastically, and then I would take another look at it and then maybe consider adding it to my portfolio. So again, for a subscriber request, again, it is a fantastic business, but what I said still stands in my personal opinion. Let me know your thoughts down below, whether you agree, disagree, whether you own Procter & Gamble, maybe you don't own Procter & Gamble. And then if you have any questions, comment down below or any other requests you guys want me to take a look at. On that note, guys, I'll see you guys in the next one. Bye.